All right, we are live and in action. Nope, I got to turn down that email, otherwise you guys are going to hear all the emails that come in. Let's turn the phone off too. Get both of those things done. And that's a yes. Yep, we can kill some of that background noise that you guys are going to get. So guys, welcome. We're really excited today to have Scott Aucutt on with us. Scott is really an underwriter for one of the places that we take non-QM loans to. Non-QM, for those of you who are not aware what that means, it's non-qualified mortgage. So non-qualified mortgage simply is, it's not a loan that we could sell to Fannie Mae, Freddie Mac, or FHA. These are mortgages that since the Great Recession or the housing bubble, they've come back into the marketplace, but they're creative options and quite honestly, better programs that put us into the housing bubble in the first place. There's more skin in the game required from the homeowners, such as higher down payments. There's more skin in the game as far as what we would really truly verify to prove that there's some income coming in, and there's a little bit more of a higher credit requirement. So they're better programs, and they're great alternatives that I think we're going to need probably more so now because of what happened with the pandemic and businesses being shut down, and the cash flows are going to be a little interrupted. And this might still be a really good outlet for some of those self-employed people. So with that being said, we're glad that you guys joined us today on Tuesday. We've got a couple other things that we'll be sharing with you towards the end as far as some other presentations and webinars we have coming up. Next week, we've got IDA. We've got one next tomorrow that we'll talk about. But let's get right into it with Scott here. And Scott, I'm going to turn it over to you. Scott, okay. PowerPoint, and we'll get rolling.
All right.
And I wanted to make sure, Tony put out a quick thing. There is a chat area. So if you guys have questions, that's how we're going to handle the questions. Just go ahead and put them in the chat. What I'll do is I'll kind of pick a spot to interrupt Scott, get the question out to him, and we can kind of tackle those things as we go. So with that, Scott, the floor is yours.
All right, Rich, do you see my screen or no?
I don't see your shared screen.
All right, very good. Hold on one second. Hold on.
No worries.
It'll pop up here in a second.
Perfect.
Looks good.
I still don't see it. So you should have to hit on the shared screen.
Yep.
Once you hit that, make sure you pick the screen with the presentation. Sometimes it'll default to our screen.
Gotcha. Thank you very much.
Yep, that might help. There we go.
All right.
All right. Cool.
Okay. Well, thanks, Rich, for the introduction. And again, my name's Scott Aucutt. I've worked with Cross Country for the last couple of years. And as he was mentioning, I mean, Cross Country has an extensive product line, you know, for customers and buyers. However, we kind of come in there and help complement that with, as he called it, non-QM loans. So I'm going to get right to this part here. Hold on. So I'm kind of going to jump to the bottom of this first slide here and just kind of say it's real simple to say what we don't do. So we don't do any Fannie Freddie loans. We don't do any VA or FHA loans. That'd be something that all your buyers are going to try to focus on the front end and see if they can get approved that way through Cross Country. And then if they can't, that's where typically Cross Country and I will have that conversation and see what other options your buyers may have available. So the big products we have right now are bank statement loans, investor property cash flow loans, and I will go over those in more detail in a moment, and asset depletion. You know, overall, you know, these non-QM loans that we're originating, these are good credit borrowers still. You know, they're 700 FICO scores, A-minus borrowers in most cases. They're just having challenges either one way with getting approved with the automated systems on the Fannie Freddie side, or debt ratios, and we just have some other creative ways to help get them qualified. So as Rich was saying, there has been, some disruption in the market. So, the stock market's been going up and down, unemployment has skyrocketed, forbearance arrangements there's a lot of people that are either, putting mortgage payments to the end of their loans, getting a creative maybe change in payment or just getting some sort of deferment. Within our sector, the non-QM sector, everything truly did disappear for almost 60, 90 days. We're really happy to be back to originating funding loans again, and looking forward to continuing the partnership with Cross Country. And yeah, I think the future outlook looks good. As we continue, we're going to continue to get more and more aggressive with our programs to help you and your buyers get qualified. So as I did mention, 90 days ago, there wasn't a non-QM loan you could originate. Even conforming loans, so your Fannie, Freddie, your government loans, everyone was tightening up a little bit, higher credit scores and bigger down payments. And we're slowly kind of getting back to things settling down.
Yeah, go back.
Sure.
If you can go back to that statement, I want to cover a couple of important things on there. So
Okay.
Scott's right. As we went into the pandemic, a lot of these programs were just completely taken off and off the shelf. Like no longer can get it anymore. They were shut down. And then there was some other changes that are kind of mentioned here. Some of the conforming lenders not doing cash out loans. That was never an issue here with Cross Country, but we had heard about it in the marketplace. Jumbo financing being tightened up. That's loosened up quite a bit as far as that's concerned. We probably even had a short couple of days where we weren't sure what was going on with the jumbo market because some of the funding for that had just literally dried up. Jumbos are back in play, so that's good and exciting. And some of those higher earning and certainly higher home prices can now get financed. Jumbos being anything over 510, 400 on a single family property. Then the FHA minimum FICOs, in a lot of cases for lenders, they immediately knee-jerked and raised them. We heard some of the banks even went as high as 700, just some real craziness. Cross Country never changed its minimum credit score on an FHA loan. Our position on it was if FHA is still going to buy it, we're still going to make that loan. And in turn, we basically turned around and sold all of our FHA loans directly to Jenny and stopped using any of our other investors because they were tightening up and it wasn't what FHA was doing. So as long as the product was there, we made that product available and did not increase any of our FICO scores. And the last thing that's mentioned here talks about the home equity lines and things. There are some banks that have just shut them off. If you have a client looking for a home equity line, reach out to me. It's not something we specifically do, but we do know some places outside of Chase, outside of TCF, that are actually still doing lines of credit. So, and certainly if anybody has questions about that, ask Scott. I'll let you jump to the next slide.
All right, thanks.
Sure.
So bank statement loans, these are probably 70% of my business monthly, and that's even prior to the, the COVID pandemic. So what is the bank statement program? These are typically for your individuals that are self-employed and they write off too much income on their tax returns for qualification. So a good option or a way to try to get them to get qualified is to look at their cash flow through the bank statements. And today we ask for 2 years worth of bank statements, so 24 months worth of bank statements. We either can use their personal account because they don't have a business account or business account, it doesn't matter. Either or, we can use them. Right now we're going up to 80% LTV on that product. I'll just give you a heads up, pre-COVID, we were going up to 90. So we should see changes, hopefully third quarter, and going forward that will start on the LTVs again, back to 90. Borrowers, we're really pretty much differentiate ourselves in the market with this. We're very aggressive with this program, meaning you don't have to be 100% owner of the business. We do allow either personal bank statement or business bank statements to qualify. We even give the borrower an opportunity if they have multiple business accounts. We can use all 2 or 3 bank accounts they have to qualify the borrower. That's rare. We don't have the borrower go to their accountant for a P&L or a certified, operating income statement or anything. We don't require that. And then we also use what they call a variable expense ratio. So what does that mean? A lot of times, if you have a business bank account, everyone's going to make the assumption that, say, 50% or more of it is going to be expenses. So we're only going to give you an example, 50% of that income to qualify. That is not how it works with our company. We are very flexible. We really look at a common sense approach, understand their business better, and we can get as aggressive as maybe using 90% of the deposits to qualify.
So Scott, I've got a question. I've got two questions, but we'll first start with Della. She had asked, I think Della is a she, can you combine personal and business accounts?
Very good question. That is something I cannot do.
Okay.
So just to clarify what I did say earlier as well, what we can use multiple accounts for is either multiple personal accounts or multiple business. So I've had 2 loans that I can think of recently. The borrower had 3 different personal bank accounts. I was able to use those to qualify. I had another borrower that had 3 business bank accounts. I was able to use all 3 of those to qualify. But you are correct. Unfortunately, I cannot use a personal and a business to qualify.
Okay, perfect. Let's see here. Okay. Second question that I had for you, it's personally my own question. I want the agents to think, the self-employed is not just for somebody who owns their own business, whether it's a manufacturer or a restaurant or a hair salon. There are self-employed people all around us that, I would think, and Scott, maybe you can give me some examples of ones that you've seen and done. But my thought process is people that are 1099 or contract employees are considered self-employed. Certainly like an Uber driver, a taxi driver, these are folks that are self-employed. Scott, if you can give me an example of maybe some other things where they're self-employed, but they maybe don't have a brick and mortar business.
Absolutely. So you're right, Rich. So very common example would be someone that's paid 1099. Mm-hmm. So if you're that could be it could even be through Uber. It could be a lot of truck drivers. I see a lot of truck drivers, and so obviously they have expenses. They're trying to obviously save from paying the IRS and why they write off their expenses on their tax returns. So we go back and say, let's look at your bank statements, and a lot of times there's a lot of cash flow that's shown through those bank accounts. And so, yeah, there's definitely, you don't have to technically own the business. If you're 1099 or subcontractor, that's fine. We also allow, which is unique, actually it could be multiple sources of income. So technically you could be a W-2 borrower and you could be self-employed as well. Part-time, full-time, it doesn't matter. And then we will look at both those income streams to qualify you.
That's great.
And another good example that I'm thinking about is a bartender, tip money. I mean, that's why they go bank statements as well. They get usually a very small minimum wage. They don't basically claim all of their tips. So bank statements, I've done a couple of those that I can think of just recently in Chicago even, people that worked at, I don't know, kind of higher end, I would say, restaurants, and the tip money was very high, and we were able to qualify them that way.
No, that's great. I was thinking of something that probably used to be more popular, like people used to sell things on eBay. It seems like Amazon has picked out a lot of those guys. But
yeah,
every once in a while, I'd get that application where the guy's like, I made 80,000, and then it's only 10,000 on the tax returns, but he's got all this cash flow going from whatever it is that he's selling on eBay or some of those places, even Amazon.
Absolutely.
I do have a question that came in. So Yolanda asks, hi, Yolanda. Is there a certain length of time you have to be self-employed to apply for this type of loan?
You're supposed to be 2 years.
Okay, so 2 years.
We do make some exceptions, though. I mean, if you're just off at 2 years, or we sometimes, it's again common sense approach with us. If it's less than that, what do they do prior to that self-employment? Were they in the same type of industry? Are we going to maybe they're going to put more of a down payment? That's always helpful if it's less than 2 years. But just as a rule of thumb, 2 years. But as I tell Rich all the time, I'll look at anything.
Yep.
So.
All
Hope
right.
that answers
So
the question.
I think we got this one covered. You want to hit
Okay.
the next slide? And
Yep.
thanks for the questions.
Yeah. So I'm gonna. Here, I'm having trouble seeing this. Hold on 1 second here. So this is kind of goes with the bank statement slide that I just had before, just kind of giving you a perspective of how cross country use bank statements over some other companies that offer maybe a product similar to, at least bank statements to qualify. So just, third party expense statement. So I was saying about the CPA, they would need a CPA letter certified, or maybe an operating income statement so they can figure out their expenses associated with their business. That is no with cross country. We do not look at it that way. We have, what I haven't brought up yet before is a self-employment questionnaire. It's 8 questions, strictly very basic questions. What do you do for a living? Do you have a commercial rent space? So in other words, are you paying rent somewhere or not? You may work out of the home. There's a lot of home-based businesses. So that's why we're asking that question. Do you have any employees or subcontractors or part-time employees with your business? If so, how much do you pay monthly on that? With what you do for a living, so if it costs of goods sold, you may not. We factor all that in with that question of that questionnaire, and then we basically come up with what we think the expense ratio is. So minimum business expense ratio with us, or cross country, is 10%. Some of the people I work with, actually, I've seen the 50% expense factor elsewhere. So what does that do? That's going to hurt your DTI, at least for trying to qualify for a loan. So we can get as aggressive as 10%. And I'll give you the perfect example of that. That's when you're a home-based business, graphic designer, the recruiter, the person that works for themselves, they're in IT. They have no overhead. They're working out of their office at home, and we just know there's no expenses. They have no other employees. They say they don't. And that's the case where we'd use 90% of their deposits to qualify. So it's very aggressive.
Hey, Scott, would
Yep.
in-home daycare, like somebody's running daycare out of their own place, that qualify as well for the 10%?
Absolutely.
Perfect.
I've done that many a times. Yes. Not a problem at all. Not a problem at all. And today we go up to 80%. I think I did mention that before. So ADL, so 20% down. Pre-COVID, as I'll just kind of word it that way, we were looking at 90. So again, as we kind of said, as the market shifts, we should continue to get more aggressive. You do not have to be 100% owner of the business. So if I have one right now, there's 69%. I've had ones that are 50-50 or 33% owners. Just simple math. We use the deposits and give them that percentage of what their ownership is. So that's a little more difficult with other lenders. They want you to be the primary owner of the business. We're very flexible in terms of evaluating your customers early. So with your buyers, if they have their bank statements, they're working with Rich or his teams, they can just send me the bank statements. I'll look at them ahead of time, so not to drag anyone through to are we going to get approved or not. We'll give you a quick answer if the loan's in a debt ratio or not. Okay. NSFs and overdrafts. Some people are maybe a little bit sloppy with their bank accounts, maybe not, but there's many reasons why they could have overdrafts that make a lot of sense. But all in all, the good news is it's not what I would call a deal killer to have overdrafts or NSFs. Just need a good letter of explanation, and then we just kind of take it from there. Anything else on that, Rich, you think? Or
no, I think that's good.
Okay.
I mean, the 100% ownership thing is a big deal. So, you've got somebody that's a partner in something, then he could actually still qualify. So I think that's great.
Okay. Very good. So investment property loans, we have a couple different ways of qualifying people that want to purchase a non-owner occupied property. Compared to Fannie Freddie conventional guidelines, one thing is how many properties you own. With us, we can be very flexible with this product. So you can have someone that has, we don't require, or I should say, you can have unlimited amount of properties owned. So a person could have 100 properties. It doesn't matter. Even if they're all financed, it doesn't matter. You're capped at 10, as far as I know. Rich, you want to correct me on that? And then the Fannie Mae type?
Yeah,
Okay.
10, yeah. Fannie Mae doesn't want to be into any one investor for more than 10. So.
Mm-hmm. And so we can finance up to 10 loans for any one investor. Debt ratios, we go as high as 50%. In terms of property types, typically I'm seeing the single families, condos, townhouses, up to 4-unit properties that we allow. but also we do non-warrantable condos and condotels. So that's typically with a condo, the more of a hotel on the bottom with, with actually apartments or condos up top that people residentially live in. So we get creative with those type of property types. And there's a couple different ways we can qualify these loans. Traditional full doc, so with tax returns, W-2s, or we actually can use those bank statements we talked about. So the 24 months bank statements, I can do those on non-owners as well. It doesn't have to be just owner occupied. And then we do have a product that's even a different way of qualifying. If you have someone that can't qualify traditionally through tax returns, W-2 income, they can't qualify through the bank statements to prove enough cash flow to qualify. We actually have a program. It's called your debt service coverage ratio, the acronym DSCR. What that is, it's more or less a no income, no ratio type of program. What you do is we just qualify the subject property and don't even focus on any other property they have. Primary residence, if they have other non-owners, don't even look at it. All we're trying to make sure is that the subject property that we're doing the financing for, either purchase or refi, is cash flow. So today, we want it to be at 1.25. So how do you calculate that? You're taking your gross rents, which is 100% of the rents, not 75%, 100% of the rents, divided by your PITI payment, your new proposed PITI payment. And as long as it's 1.25 or greater, the loan will get approved. I'll say pre-COVID, we were at a minimum 1.0, or we were even at 0.80 in some instances. So in other words, a negative cash flow, and we were qualifying those borrowers still. So again, as the market improves, I think we'll get more aggressive, and this cash flow, our 1.25 will be reduced, at least to 1.0. So just from a number perspective, so to be at 1.25, you would have to have $1,000 rent, again, 100% of the rents, and a $750 PITI payment. That would be 1.25. So anything greater than that would work. We also get...
That's perfect, actually. That's a great example. I was thinking $1,000 PITI and then $1,250 on the rent coming in, but that's a really good example. And this is a product too where, and Scott, correct me if I'm wrong, but under this no debt ratio or DSCR program, we're not listing employment, we're not getting into tax returns. Is that accurate?
So yes, half and half there. So technically you are going to state the employment on page 1 of the application.
Okay.
The only thing that's left off of the application is going to be the income on page 2. Okay.
So we state whatever it is they do. If they are, and this kind of segues into a question we have from one of the participants, if they are a property manager, they could put in that they are ABC Property Management, and this is part of their
Absolutely.
job. Okay,
absolutely.
Good. So
absolutely.
Going back to the bank statement piece and the ability to not go 2 years. So if I have a real estate agent who's full-time now for 12 months and her prior job in W-2 happened to be a property manager for 6 years, do you think that gives us grace on the bank statement program?
That sounds like a little bit of a challenge, just because you're being a property manager and now selling homes. So I would say there's kind of a shift in the, what you do for a living. I guess, of course, as I said earlier, I like to look at anything Rich has, is that, what about credit depth? What are we working with here? Are we working with someone that's a first-time home buyer? Or are we actually looking at somebody that has a home today and, just in showing that they're continuing to pay their bills on time? What is the loan to value? Is this, if it is a cash out refi, I guess that's one way, but if it's a purchase, how much is the down payment going to be? They're going to put an extra, maybe they're going to put 40% down. I don't know. I'm going to look at everything. That is definitely the exception on the file. But we would look at that very closely. But it sounds a little bit of a challenge, but if everything else is just perfect and putting large down payments, I think someone would entertain that.
So Scott, in a little clarity from Yolanda here. So she had mentioned that she has been an agent for 10 years, but maybe was part-time for the first 9, got rid of the W-2 job as a property manager, went full-time in July. So if
Okay.
you're talking the bank statement program, which really is really more of an owner-occupied product anyway, if we're talking that bank statement program, I know you mentioned it on the investment. I'll get to where I'm going with this in a second. But if she had 10 years as a real estate agent, albeit one of the two was full-time, the bank statements might just not reflect great cash flow as far as that's concerned. So if her cash flow was amazing in the last 12 months, but maybe not so much in the previous 12 months, we're just going to average that out. But it still could be something that worked for her because she had the license and was an active agent. Is that
100% agree. I 100% agree with that example. Yes.
okay?
Yes.
All right, perfect.
And just to make sure, bank statements we allowed on owner occupied and non-owners.
I know, I'm sorry, I said that. I just think that if you've got, and we do through the product certainly allow it on the non-owner, but I think in many cases that debt service coverage ratio program, it solves a lot of hiccups we have when we get into some files. I mean, we use that as a great product for when a file kind of goes south. Maybe, you know, for example, right now, maybe they were out of work for 3 months because of the pandemic. There's no income at all. The bank statements aren't even going to look great because they were closed as a non-essential business. So this would be a good deferral to this debt service coverage ratio program.
Mm-hmm. Absolutely.
Let's see here. So, yeah, this is, so Dala wants to know is, as far as the down payments, can part of the 20% down payment come as a seller contribution? My answer to that would be no, but I'll defer to the underwriter on it.
Yeah, I'm gonna back up and maybe just make sure I'm giving it. I've talked about LTVs a little bit. So, so on the owner occupieds right now, you know, the max we do is 80%. Okay, that's either bank statements or traditional full doc. If we're going to do non-owner occupieds, if we're going to do traditional full doc or bank statements, we're looking at 75% max right now. The DSCR program right now is max at 70. Okay, and so to answer your question, we allow seller concessions. Seller concessions we allow up to 6%. But if you're kind of talking about them maybe doing a carryback or, you know, giving them some of their down payment, they can cover seller, you know, through seller concessions up to 6% for closing costs, but not give them a portion of the down payment. We do allow some gift though. So, you know, honestly, at 75 LTV or below, we can pretty much allow 100% gift. So it just kind of matters the situation a little bit, but you're right. No seller providing money over above beyond the seller concession.
Yeah, a lot of that Dala went away. There was some of that going on pre-housing bubble, pre-2008. Really, the commitment now is that the seller's not helping with the down payment for the most part on any product. So,
right.
I think let's see here. Oh, you know, we stopped before the good part. We can use interest only to qualify. That's a great one.
Yeah. Yeah, so it really helps with the 1.25 requirement for positive cash flow. So we actually have the ability to use an interest only as a start rate on that product of the DSCR to help, you know, could be, say, just an example, maybe 1.15 with a fully amortized payment. If you go to an IO payment, interest only payment, it couldn't get it over that 1.25 mark that we need to be for qualifying. So that's where that interest only comes in. We actually do interest only on there's our other products as well, though. Owner occupied and non-owner, full doc, bank statements. And we actually have one of the best parts of the IO, if people are interested in, is that it's a 10-year IO. And we also have, it comes up with a 40-year amortization. The last 30 years, it's fixed as well. So your start rate is the same for 40 years, but the first 10 years is IO, interest only, and then it just converts to a principal and interest payment for the next 30.
That's a great product.
Yes. Yep. All right. Any other questions on this one, you think, Rich? Are we good?
Yeah, I don't see any, and I haven't come up with any either that'll help. So we'll go to the next slide.
All right. So one thing we were, I was kind of, early saying on that, sometimes for debt ratio purposes on a, just a standard full doc or even bank statement power, if you just can't get them qualified through, conventional channels, Freddie and Fannie Mae and Freddie Mac, when they have, someone that has a rental property or multiple rental properties, and just overall they have a negative cash flow, through conventional financing, they're going to hit that as a debt against them on a monthly basis. The way we creatively look at negative rental cash flow is we offset it with their income, and it makes a big difference. And I'll give you an example here. So the Fannie Mae calculation is income for these two borrowers, Roger and Stacy. They come up to $12,537. Through our calculation, we give them the same income because that's what they make. These are W-2 borrowers in this example. Yep. But what we did was, of the properties they own today, they had a negative cash flow of just over $2,300. And then their property they were looking to purchase was going to show a negative rental income of just under $1,200. As you can see, we took their gross income, subtracted out all those rental losses, and we came up with income of $8,900. So far, it doesn't look so good when you see Fannie's giving them $12,000, we're giving them just under $9,000. But if you look at it closer with that calculation, because you can see Fannie Mae, because of those rental losses for their existing properties and the new property they were purchasing, they added it as debt. So because they did that, it puts their debt ratio over 51. In our example, using the same numbers, just how we use the negative cash flow against their income, instead of holding it as a debt, we're at 32 back end. So I've had many examples of people having trouble getting their debt ratio in line with rental properties. And then, we just kind of work our magic this way, and we can get them qualified every time. I mean, not every time, but you know what I
mean. Yeah, but it helps. That's a great example of being creative to make those numbers work. So.
Absolutely.
That's awesome. So we have, as we go to the other slide. No, you can go to the next one. I think nobody's got questions on that. Dala had asked if we can still do an 80-20. I'm going to leave that one up to you, Scott. So
I like the question. 20% down, yes.
Yeah, 20% down, but there's no such thing as an 80-20.
No,
people have to have, I don't think anybody on this call wants to go back to 2008. So it was a pretty rough run for the country, for anybody in housing. But having somebody have a commitment, have some money into the game is really important. So. Yeah,
so as I kind of mentioned a couple times, like pre-COVID, before our current guidelines we're talking about, we would go up to 90%. Kind of like Rich said, 90 is the old 100. So
yeah, right.
So that's kind of how it is. But again, we'll scale up and get to back to 90. I am very confident with that. I'll just rush over this one pretty quickly. I mean, for a national program, there, certain parts of the country, we see more of this, these types of loans. What we do know, the Asia Pacific region, I mean, they're wealthier than North America. We know here people are spending more money, on average on a house than, us here in the U.S. And with this foreign national program, it's really, it's a good program. It's easy. You just got it's a couple different things you got to think about though. So what I find is these borrowers are putting large down payments. They're not stretching, trying to say, can I get 20% down? A lot of times they're putting 50% down. So there's a lot of cash that they're looking to buy these homes. Now, when you're on a foreign national program, you're buying it as a non-owner or a second home because technically you live in another country. So today we're going up to 65 LTV on these on purchases or 60% on a cash out refi. I just looked at two today. Foreign national borrower had two free and clear homes here, and we're looking to approve that as 60% and get the cash out so we can buy more property. It says credit scores are not required. The reason why that is, it's based on which country you live in. You may or may not have, they may not have a credit system. So if they don't, then we go revert back to just getting credit reference letters or some institutional letters where they may have a car loan or just even credit cards. We even allow the borrower to pull their own credit report if it has a credit system, as we can here with the annualcreditreport.com situation. They can do similar things in other countries. So if there's a credit system, we definitely go that route. If there's not, we just get letters. And same with the income, very easy. Obviously, it's going to, the income, we can get CPA letters, don't have to be self-employed. We can get letters supporting what their earnings are. And we actually do the DSCR believe it or not. So you actually can go no income, no ratio if you want to on the foreign national. And so yeah, every deal's a little bit different. Again, kind of comes down to that credit system or not. Do they own a home here or not? You know, some people find out one of the borrowers is a permanent resident alien of the U.S. One other borrower isn't. So sometimes it gets a little creative, but we definitely step up on these type of deals in a lot of cases because of the large down payments, and they show they have good pay histories in the past.
Yeah, I had a quick question for you. What are you seeing? Like, what's your average loan amount in this type of program?
For the foreign national?
Yeah.
I would say it's got to be at least 350 at least.
Yeah, that's kind of what I would think. Like when we see these kind of loans come through, they're definitely higher purchase prices. So, you know, it's always something that if you have an in to work this type of business, the purchase prices tend to be much higher. So.
Absolutely.
Yeah, perfect. We think we're good on questions. So.
Okay. So just kind of because I'm just going to kind of recap some stuff. I went over most of it, I think. So I know, Rich, on the bottom, I'll start at the bottom here. I mentioned jumbo loans and the max at, what was it, 510, 400, you said? So we go up to 3 million. So that's when we get calls, you know, for those loan sizes that don't meet the Fannie guidelines or FHA guidelines. And so jumbo loans up to 3 million. I got one in the house for 1.6 right now. Got another one in, I think well, actually, we're trying to get 3.2 million. I haven't got too far on that one yet because I need to figure out if I can go over 3 million. but there's, you know, that's definitely where we entertain a lot of loans and bank statements, no problem. Jumbo loans and bank statements, it's very common actually.
That's great.
When you have your self-employed borrowers. So cash out, you know, we're pretty flexible with that. We already talked about the type of properties I can work with. Yes, we can do rural properties. You know, second homes, jumbo loans, and we talked about the DSCR and bank statement loans. So, you know, I didn't talk about asset depletion. You may have borrowers where it can be in multiple sources of income too. So asset depletion, technically, any borrower that has $500,000 in the bank or more, post-closing, that means if they were to purchase a home after the down payment, they would still have the $500,000 in the bank. We can use a calculation. We divide it by 120 months and use that as a monthly income figure. And we've used it as well as an exception basis if they're W-2'd or maybe bank statement borrower. Maybe they're a little bit high in the debt ratio alone. And then we found out they had some assets and we kind of work that into the figure to make them DTI. We talked about interest only so we do non-permanent resident alien loans, permanent resident, as you know about the foreign national. I will bring this up. We had an ITIN product. So, it stands for individual tax ID number. So we've had that product. That's the one we did not bring back just a couple weeks ago. However, I've been told verbally we probably will get it back in the third quarter. There's over 30 million borrowers that are ITIN in America at a minimum. You may or may not be aware of them, but the Social Security number, it'll start with a 9 number. You always see they start with a 900 number, but they're paying taxes and to the IRS, and they're just known as an ITIN loan. But we see a lot of those in the past, and we're going to see a lot of them once they bring the product back open in the third quarter.
Yeah, I want to expand on that a little bit on
Sure.
the ITIN stuff. So. Scott, through the company that we work with him, they're looking at bringing that back in the third quarter. We have some other companies here across country that we work with that also provide it. Unfortunately, they looked at Illinois as a higher risk state because our unemployment was higher due to the pandemic and due to what was going on. So I think those products will eventually come back. We do have a more local source of a bank that turned that back on. So, and actually they're only looking for like 10% down. So in the meantime, you know, I'm not here not to help any buyer, but if it's not me and you've got a buyer that wants to do something, you know, give me a call and I'll get you hooked up or connected with the bank that'll take care of them on the ITIN. As Scott has mentioned, we hope to have a more more options, product options for those in the third quarter. So one other thing that I want to talk about on asset depletion. Asset depletion is really a perfect product for a customer who just sold a business and they've got a huge account. They have no business anymore, but they've got a huge account. Now they want to take a little portion of that money and buy that house, that dream house or whatever it is, even though they'll have 7 figures in the bank. That would be a really good candidate. Another candidate was something that we did last year. We had a doctor who was getting divorced. He had to refinance. Not only did he have to refinance his ex off, but he had to write a big check to her. And ultimately, because of the amount of child support alimony that he was now included in his budget, he was not going to qualify off of traditional lending. Had worked with Fifth Third and some of the other banks, and they all said no because his debt ratio was 65, 67%, depending on how you cut it. With the new alimony and child support, we were able to take his bank statements and add the depletion portion to the existing income, get his ratios down, and provide a good outlet. So, that asset depletion thing on the bank statement side, or I'm sorry, the asset depletion program allows us some additional flexibility for unique situations. So.
Yeah, and I will add on top of that, it's a good example, Rich, is we had what we called asset qualifier program prior to the COVID pandemic. And what really the big difference with that one is those assets, the 500,000 minimum you're supposed to have, we divided by 5 years. This is over 10 years, the asset depletion. So even more opportunity to generate more monthly income for qualification purposes for help with the DTI. So that should be coming back as well, I think. We do lease option and land contracts as well. I see a handful of these every month, and the key on those, if familiar with them, you just want to make sure we can prove they're making their payments on a monthly basis. Your investor is the DSCR loans you're talking about. I mean, very common that I see that the loan, they want to put it in their business name and not as an individual. That is okay. So they could keep it in an LLC, either refi or purchase. We allow that. So as an investor. And from your borrower standpoint, I know it's, someone asked about the 80-20. This is a little bit of an area where we can kind of help. It's kind of with your borrowers. Obviously there's closing costs to every loan. We have the ability to finance some of those points on the front end of the loan into the loan amount. So a net effect, of course, is it reduces the amount of cash they need to come up with closing, on top of their down payment. So that's a very helpful feature that we have. And so that's, any questions on any of that, Rich?
I did have a question come in. You won't be able to answer this one, but I'm going to address it. So Yolanda asked if there was a 203K for non-QM. Essentially, the question is there rehab lending available in the non-QM space? With Scott's company, that's not a fact, correct? You guys don't have to do construction. Okay. So with rehab lending on the non-QM space, you're talking more private money. Cross country, we do have an outlet for that on the private money side. Again, they'll lend. Your investor likely has to have about 20% into the project cost, and we have some outlets for that. So that would be something that just for all the participants, you can bring some of those rehab transactions to us, Yolanda. On the traditional non-QM, we don't see it there, but there's another kind of space or avenue for that, if you will. But one other important thing I want to cover. So Scott, properties can be in LLCs. I constantly get that from agents. My borrowers want to buy this property in an LLC. Well, non-QM, that's definitely the way to do it. So, and then the lease option and land contracts being treated refinance is pretty strong as well.
Mm-hmm.
Yep.
All right. Well, that was it for me.
Cool. So we got everything in the chat. The chat's a great place to ask any other questions that you guys might have. If you guys are working on that, or if we're done either way, I want to segue into present. I'm just getting a little feedback anyway. I want to segue into, this is a little bit of short notice, but the speaker's really, really worth it. Cross Country as a company is presenting a gentleman by the name of Steve Richmond. He's a professional speaker for one of our mortgage insurance companies. He's actually speaking tomorrow between 9:30 and 10:30 on 9 skills to embrace today. And he'll be going through some newly acquired habits such as video techniques, some branding strategies, some training tools, and basically how to implement that. The one thing that I will tell you about Steve is not only is he very cutting edge in he's bringing you the newest apps and the newest things that you could use to create, generate, and build your business, but he's also tremendously entertaining. So, he truly could end up on one of the Tonight Show or something like that. You guys will enjoy him. I know it's short notice. It's something the company's provided and not something we're doing directly through the branch, but we're going to get that invite out to you this afternoon. Check out Steve Richmond if you have time. I guarantee you walk away with something. You learn something from the time that you put out there. Tony looks like she put in that looks like the registration for Steve Richmond, but we're also going to email something out to you later this afternoon. Great guy to see. Scott, it doesn't look like we've got any other questions.
Okay.
So thank you for carving out a little bit of time while you're up north.
Absolutely.
And,
I enjoyed it.
Yeah, so we appreciate that. Appreciate your time. And Tony, thank you as always for helping me put this together. Couldn't do it without you. Everybody else, have a great day and look for the Steve Richmond invite. You guys will really enjoy that. Take care, guys.
Thank you.